All right, so it's 2:01. I think we'll get started with our introductions, and if more people jump on, we'll welcome them in as we go. So welcome to our first ever Dairy Strong webinar, and we have Mike North with us. We'll be presenting. So first of all, I'll just cover a few notes. We have the audience muted for the presentation to help with our audio quality and everyone's participating pleasure, I suppose. So there will be time for questions at the end, and we also will use the instant messaging function for questions. So if you don't see this box with our conversation, look in the lower left-hand part of your Skype screen, and there should be a little conversation bubble icon. If you click that icon, a conversation box will pop out and you'll see a welcome message. And if you have questions, feel free to type them in there, and Mike will take questions and answer them at the end of the presentation. So like I said, we're hoping this is the first in a series of Dairy Strong related webinars. Hopefully we'll start doing them with more frequency, and please keep in mind that we're testing out this platform, so we ask that you bear with us and have patience if we have technology issues. It's our first time using this as a platform for presenting to a big audience, so we hope that it works, but like I said, please just have a little bit of patience. So we'll get going with our presentation. I'll like to introduce our presenter, Mike North. He's the president of Commodity Risk Management Group, and Mike grew up on his family's dairy farm in southeastern Wisconsin. He graduated with a Bachelor of Science in Agribusiness with a minor in Dairy Science from UW-Platteville. Mike's been working in the futures industry since 1995, and since then has been working with production and processing clients to construct marketing plans and margin management plans. Mike uses his experience to educate businessmen about the tools available for price protection and risk management. He's been published in several agricultural periodicals. He's regularly featured in the Wall Street Journal, Bloomberg, and Dow Jones News, and is a regular guest on several national TV programs, and he can also be heard frequently on several local and national radio programs. Additionally, Mike is currently serving as the president-elect of the Board of Directors for our Dairy Business Association. So we are really excited to have Mike as our first Dairy Strong webinar presenter, and I will hand it over to him to take over the presentation.
Fantastic. Well, it certainly is a lot of fun being able to get together with people in whatever capacity it might be. I guess I'm glad to be the guinea pig to see how this new technology works, and I'm excited to be able to spend some time with all of you looking at the dairy markets, the feed markets, and some of the periphery that will be impacting us in the course of the coming months and year, and talk a little bit about at the end in fielding your questions what kind of direction we should maybe be taking as a result of this. I think as we spell out a lot of the different impacts, you're going to see firsthand why so many people have the outlook that they do, and some of these conclusions that have been drawn maybe come into a little better light. So with that, we'll get started and talk a little bit about this ongoing market. I guess a little information on the company. We are headquartered in Platteville. We offer a wide variety of services to people. If you have questions on that, we can always talk aside from this this time together. But let's move on. If we look at the world around us, there's a lot of different things that have been playing out over the course of the last few months that have had a pretty dramatic impact on price. And one of them in the last few weeks has been our dollar and its strength relative to the basket of currencies which in the dollar index make up its scoring. And so as we look at the dollar today, we're just shy of 100 on the index, and a lot of people have looked at that as potentially a lid for this market. But if we go back and we look historically at our dollar, over the course of the last 30, 40 years, it's not been out of the question to be at points well above that 100 index. And so while we're near it, this is perhaps not the end of this ongoing strength. Well, what does that mean to us? Well, as we look at our currency relative to other currencies, what it ultimately means to anybody that's in the business of buying and selling commercial goods across international boundaries is that we have this relative advantage or disadvantage based on the strength of our currency. And if you look at this chart here, you see how the dollar of late has compared with the euro. And what you're going to find is that they're often at odds with each other. They have a very indirect relationship with each other. And a lot of that has to do with the weighting of the euro inside of the value of our dollar. At this moment in time, about 47% of the dollar's weight comes from the euro currency, and so as it loses its strength, it necessarily gives strength to the dollar. And you can see right now our exchange rate is about 106, 107 to 1, the dollar against the euro. And as that euro continues to weaken, it gives European exporters an upper hand on markets that we're trying to gain access to or maintain business in. And likewise, as our dollar grows in strength, we lose that advantage that we once had. It was all the rave a number of years ago that the U.S. dollar was cheap enough that we were a preferred source for a lot of different product. That edge has been coming off, and you can see that spelled out clearly in this chart here. We talk about energy prices. Energy over the course of the last several months has maintained a value that's among some of the cheapest we've seen. And in fact, if you look at this chart, you'll notice that we're hugging the 2009 lows. Haven't quite gotten to those points exactly, but we're close enough at this stage in the game where there's a lot of talk that prices of energy may start to rebound, and we'll see some of that play out over the course of the next several months as we know more about different economies and the strength that we see in world economies breaking into the new year. So energy prices, relatively attractive right now, but may be changing. As we talk about the economic strength, as I make mention of that, one of the biggest stories that we've had in the course of the last several months has been that of China and what's going on there. You can see why there was so much concern as we came through the summer. They've had a third of the value of their major index cut right off the top, and that has created a lot of questions about the legitimacy of some of the numbers that were reported earlier and some of the ongoing strength that we may see in their market, which obviously leads to other thoughts of how much they're going to be buying at a wholesale level to produce products for export into other markets. And with Europe contracting and the United States kind of in a holding pattern, there's been a lot of question over how solid the ground is that the Chinese economy is built on in this moment. So big correction there. Our own market followed suit. You saw a big sell-off in the late summer months, and fortunately for investors here, markets have rebounded. We're back to nearing some of those old highs, and that has certainly played well into people's mindset. The consumer confidence ratings have continued to grow over time. You've noticed some ebb and flow. What is a little bit important to recognize is over history, this is a 5-year snapshot, but if you look at the bigger picture, when we get to the 100 the 100 number on the index, that's when things start to become a little bit tougher to breach, and you're noticing that in the course of the last several months. We have had some sell-off on a few different occasions, a little bit of resistance, a little bit of tough time going through. So some of this rocky road might be around for a little bit of time yet. As we look at what's going on with interest rates, that's certainly a big part of this discussion. The interest rates at basically zero right now, and obviously lots of chatter over the course of the last several months about the Fed making an adjustment to that and raising rates. December looks like it's probably that point in time. There's a lot of posturing that's been taking place in the market here of late, different news stories coming out following Fed minutes that are highly suggestive that there's a rate increase coming maybe as soon as 3 weeks from now. So that'll certainly be another watch point. But, as we look at all of these things, as we talk about world markets and currency values and interest rates and energy prices, the one thing that we have to really kind of tip our hat to is that a lot of our markets over the course of the next several months are going to be very closely following weather. And certainly as we take a look at what's been going on in the West, there's been a severe drought that's going on 2 years, and hopefully there's some rain coming. The way the weather patterns are looking, there's some talk of lessening the drought in the West, and certainly as we look at the pockets throughout the central United States, there's a few areas that could also use a little bit of water, and over the course of the last week or so, some of that's been starting to change. So future drought monitor reports will likely start to shrink some of those yellow and brown areas that are interior to the country. But on top of all of this is this El Nino discussion. And if you've been following that in the news, there's a lot of talk that El Nino is still in a full swell, so to speak. But there is some discussion that in monitoring the oscillator, we might start to taper back off, which would be suggestive of movement towards more of a La Nina pattern in the next summer. And what that means to the United States is a little drier conditions. I hate to use the drought word, but it's the one that the market will first apply. So these are some of these conditions, and obviously as we go through the year, the one thing that we have to kind of embrace is that the only certainty we'll have is the fact that there will be complete uncertainty in our markets. There's a lot of things going through transition and adjustment right now, and that will cause a lot of heartburn in the market as people try to make sense of it. So as we try to make sense of it, let's first talk about our feed markets. We've just come through harvest, and as we talk about what's been going on in terms of corn and soybeans, one of the biggest conversations has been yield. And through the course of summer, with all of the wet weather that we saw, there was lots of discussion that yield shouldn't be very good. That's turned out to be just the opposite. In fact, in our last report, we saw the USDA score the U.S. national corn yield at 169.3, just slightly lower than last year's record number of 171. And so what that means to us is our ending stocks have grown, both here and around the world. And if you look at the orange bar, what you're seeing is a scoring of the ending stocks left over after we've met all of the demand. And you can see that the amount of leftover supply of corn around the world is at a record level. We're sitting on some massive, massive stocks. Now, if you look at the blue line, that's the stocks to use ratio. So it's all those stocks divided back into the total demand. And you can see that we've gained some ground even further this year over last and are back to stocks to use comparables of 2001, 2002. And obviously, if we go back to those periods of time, we remember that corn didn't have a 4 in front of it. It didn't have a 3 in front of it. It had a 2 in front of it. And so as we talk about pricing and we look at feed costs going forward in the year, and certainly this is going to be a piece that plays out in your discussions and considerations regarding MPP, it looks like feed is going to be not just abundant, but relatively well priced for those that are buying feed in the coming months. If we narrow the focus and look domestically here, our stocks to use ratio is at 12.9% after the last report. That red line represents the average price paid to farmers, and you can see that the USDA is pegging that very comparably to what we saw in 2009 when we spent a lot of time in that $3 range. So what is that? What's it going to take to change that? For some reason, the years didn't come through on this. But if you focus inside the right-hand circle, there's a yellow dot that represents this year's stocks to use ratio. And you can, if you look at the dots around it, see there's a little bit of a pattern. Those represent the years 2007 up through 2010, and then of course this year, and the red line represents the relationship between stocks to use and price. As you slide over to the left-hand circle, you see the years of 2010 through 2014, so leading up to and immediately following the drought. And basically, as you plot those different points out, you can see, as you look at the stocks to use at the lower on the lower axis, on the horizontal axis, that stocks to use were much tighter at that period of time. Now, when you compare those two different camps, the separation between the right circle and the left circle is about a 4 to 5% stocks to use ratio, or roughly 550 to 700 million bushels. So if we look at this year's harvested acres and equate that back to what this means in terms of yield, we're talking about 6 to 8 bushels to the acre. So we go back to the comments about weather. If there starts to be some concern about next year's weather, and we're in a place where we need to buy acres, because remember, 2015 we maintained our ending stocks with bigger yield and smaller acres. So if acres remain small and yield comes into question because of weather, that will change people's outlook on price. So as we talk about corn and where we're at relatively, the thing we have to recognize is that acreage, weather, and yield are going to be big discussion points going through the winter, not just here, but what's going on in South America as well. As we look at the rest of the demand picture, the ethanol sector is continuing to just maintain its normal pace of growth. Ethanol stocks are in pretty much the same territory that we've been camped out at over the course of the last several years. Profitability at the plant is looking pretty good, so we're not too concerned about any departure there or any massive change or growth in usage from the ethanol sector either. So things are pretty much static when we talk about the ethanol industry and their demand for corn. When we talk about exports, well, you can see that we're lagging. The 5-year average, as we look through the first part of November, and this basically follows the new marketing year, is at the moment running about 20% behind schedule. So exports have been a little bit light. We saw some adjustment to that in the last report. There's talk of more adjustment just based on what we're seeing here in the numbers. And so that's an area where we could see a little bit more corn work its way to the bottom line of the balance sheet, and consequently, again, create a nicer price scenario for anybody that's buying feed. So here's where we're at, and if you look at December 2015 corn, what you're going to notice is we've been down in this 360 range over the course of the last week and a half, and when you compare that to where we've been over the course of the year, you're going to find that we're sitting here at contract lows. So in terms of opportunity, things really couldn't be any better than what we've seen through the course of the last 12 months. As we talk about next year, what you'll notice there too is kind of along those same lines, with exception of that quick little spike in August following the report, we're sitting in those same contract lows. And certainly as we talk about feed costs for the coming year and look at our own margins, these type of opportunities start to be something worthy of consideration. Soybeans, basically same story. And if you look at that same yield curve that we were showing earlier in regards to corn, you'll notice that we're going to have a record soybean yield this year. 48.3 bushels to the acre is the current projection. There's some talk that that could go up as we go deeper into the winter and finalize the numbers in the January report. Regardless, we're looking at a record yield. So what does that do? Well, same story as corn. Stocks to use numbers have grown significantly, and if you look at the comparables, we're back to areas we haven't seen from a stocks to use standpoint, that being the blue bar here, since 2006, 2007, really before all of these prices took off in any major way. And when you look at the red line, at a time when prices of soybeans were right around $6 a bushel. So certainly soybean farmers are a bit concerned about prices going forward, and this illustrates exactly why they have that concern. When we talk about world numbers, if you go back and look at the last 7 years, this is a comparison of production versus usage. What you're going to see is 6 of those last 7 years we've had greater production than we've had usage. And only that 2011 year where we saw the big South American drought, and then that rolled into the 2012 drought in the United States, did we have a massive departure in terms of production away from that usage curve. So we've been building supply, and as you look at what that's done to the stocks to use numbers, which again is the better comparison than just total stocks, when you look at the ending stocks, the orange bar, and the stocks to use, what you're going to see is record ending stocks and the third largest stocks to use ratio we've had in history. And so as we go forward, obviously protein is going to be available and hopefully at a little better pricing than what we've seen in previous years. As we look at the December soybean meal chart, you're seeing that play out in the futures markets. We've recently breached the summer lows and now are showing prices through the course of 2016 that are very near to that 285 line, which as we look at soybean meal relative to the price of soybeans is a very, very good deal, and ultimately in the coming months may only provide a small amount of extra opportunity than what's being presented right now. So let's talk a minute about what's going on in cattle prices, because obviously this is a revenue source that over the course of the last few years has become much more important than we had given it weight to in previous years. But this cattle market has some interesting things going on, and we go back to that discussion about our U.S. dollar, and we talk a little bit about whether we've had one of the best pasture years that we've had in the history of raising cattle. And so a lot of growers were able to keep cattle on pasture much longer than they were able to in previous years, and as a result, we have a lot of cattle that are filling up feedlots, and we're very much behind in terms of staying current on heavyweight cattle. When you look at exports, the export numbers have been, let's just call them, disappointing. End of the day, over the last several months, exports have lagged anywhere from 5 to 10 to 15% behind where they were in previous years, and that has its own issues. Ultimately, if you're not getting rid of it to other countries, you've got to get rid of it internally. The challenge with that, of course, is that with our strong dollar, not only have we not exported more beef, but we've also imported more beef to the tune of about 36%. And so you can probably see where we're going with this. Less exports, more imports. Where does that go? It goes in the freezer. And as we look at the cold storage numbers over the last several months, you're seeing that they're taking a direction that we often don't see this time of the year. Ordinarily, things are still moving lower as we go into those August, September time frames, and we began moving higher in that period of time. And as we wait for the next cold storage report, which comes out next week, we'll get our next look at it, but based on everything we know today with weekly export reports, it looks like those numbers are going to continue to climb. So a lot more beef in storage. What has that done to prices? Well, the obvious. We've seen cash steer prices drop. Futures have followed with them. Massive sell-off in the month of September, taking us down to prices that we hadn't seen since back in 2013. Had a nice recovery, but we've given a lot of that away in the course of the last week and a half, and markets have retreated back to that 125 to 130 range, certainly a long cry from the 170 numbers that we saw late last fall. So cattle prices have been softer, and frankly, given the dynamics of that market, the value of our dollar, and the current nature of feedlots, it doesn't look like this is getting any stronger anytime soon. So cattle markets, don't expect a lot from them. Let's get around to this milk market, shall we? In keeping with this discussion of the beef markets, I think it's important to take a look at what we are doing in the dairy sector with regard to our own cattle numbers. Bottom line is there's been some pickup in dairy cow slaughter in the course of the last several weeks relative to the year prior. But if you look back over history, we're still well below where we were in 2013 at a time when profitability was even much higher in the industry relative to what it is today. So as we look at those numbers not being off the charts or anything that's highly dramatic, and we combine that with the price element and talk about what's going on in the futures market and what people's expectations are. Our next question is well, what do we see changing, and what do we expect? Well, over the course of time, if you look at the last 5 market downturns, what you're going to find is that on average we reduced the herd by 138,000 cows. In 2009 it was much steeper than that. We were north of 250,000 cows, but this is no 2009. The big question is what does 2015, 2016 look like? What will that downturn lead us to? What kind of culling rates will we experience? If we run the average and we take 138,000 cows out of the picture, and you can see we're just off of our peak here from a few months ago. Essentially, that takes us back to about 9.2 million head of cattle. And if you look at how that compares to previous years and what's happened, you'll notice that we did this in 2012 as we were coming through the drought. We did it again in 2013. And as we did that, the blue line here represents price. Essentially, what that led us to are market values that were in that neighborhood of about $17 to $18. So if we see some culling, that's kind of our hope as we look forward into the coming year in the kind of impact that we might project as we talk about the upside of 2016. We talk about head, we look at milk production, and you can see over the course of time, we had a really big spring and summer relative to 2014. Production was up 2%, some really nice comparables. That's starting to flatten out a little bit. As we came through September, we saw a little lesser change, 0.4% over the year prior. October's production report comes out next week, and we'll get a look at that. Really not expecting too much different, 0.5 to 1% growth year over year, given all of the numbers that we're seeing in terms of milk receipts as they're reported greater in different parts of the country. We look at milk production aggregate across the country, and given the cow numbers we're holding and the kind of production per cow efficiencies that we have, what you're seeing here is some really nice aggregate milk production year over year. And if you look at each year preceding this one, you'll notice that we just continue to climb. And so as we talk about even the reduction in the herd, it's important to recognize that because of the incredible management that our dairies have, cow numbers don't always necessitate less milk production, and we need to keep in mind that over time, and you can see 2009 is still included in this chart, over time the general trend continues to be moving towards more and more milk. And so obviously demand has to keep up with that, and we'll talk about that more in a moment. But how does this compare to what's going on in the rest of the world? More production in the United States, sure, but what's going on elsewhere? Well, if you look at the bars from left to right, what you're going to notice is contribution in terms of aggregate tons, and on the far left is the EU. And if you look at their growth, they're also in that 1.6% territory. But I think it's important not just to talk about percentage, but to also talk about what that percentage means in terms of total milk production. Here it's illustrated in tons, but obviously we can talk about it in pounds or hundredweights or however you wish. Bottom line is the EU is putting out a lot of extra milk, and as we work our way from left to right, you can find New Zealand third from the right, and you'll notice they're down 0.9%, but their 0.9% doesn't compare to what we're seeing in growth in other places. So there's going to be a lot of press on New Zealand. We'll talk more about that in a moment. But if you get a snapshot of what's taking place in the major production regions, you're going to see that growth continues. In fact, when you look at this discussion about New Zealand, they were down 7% in their September number. There is talk they could be down 10% for the season. But when you look at the aggregate, and again, go back to looking at the big picture and talk about all the major contributors, what you're going to notice is the milk production line continues to hold. And here we see, with exception of February and March, every month going back to 2013, the summer of 2013, we've had continued and ongoing increased milk production year over year. So What's going on? Where's all this milk going? Well, um, essentially it's going into cheese. That's been one of the biggest production avenues, and as you look at year over year growth, month by month, what you're going to notice is in every single month this year we set a new record for cheese production. More and more milk going to the vat, more and more cheese being produced. That's true around the world as well. If you look at Europe, we're seeing the same kind of trends there, where cheese production's been up about 1.5 to 2% as we look at the entire year, but certainly that's where the trend is. Whey, if you look at whey, again, month over month this year relative to the last year or the last couple, you're going to notice that this was a good year for whey production. A lot of extra milk going there, and obviously a consequence of more cheese. You look at whey protein concentrate, not quite as big of a year, but still a relatively strong one. In most months, we're down from 2014, but still holding our own or slightly higher than where we were in 2013 and the years preceding that. Milk protein concentrate, another one of these categories with big growth, and that's part of the give and take here between the WPC and the MPC. Little extra going into the MPC category as demand begins to shift in this direction. Butter, this is an interesting one to take a look at. If you look at butter production here in the United States, you're going to notice that a lot of the months this year is down from last year and down from the year before. And what that's allowed for, as we've seen play out in the markets this year, is another run back towards $3 butter in the fall, and much stronger prices here domestically than we see around the world. And we'll talk more about that here in a moment. European butter production, on the other hand, has been relatively strong. If you look at where growth has been, they've been pushing a lot of their milk into butter production, in addition to the cheese production that they've been continuing to ramp up. Non-fat dry milk, the only month this year where production didn't exceed last year was in the month of July. Otherwise, some really big numbers coming out in the non-fat. Same with what we're seeing in the EU. The skim milk powder production has been up very, very strong. And if you look at the numbers year over year, obviously 2014 was a big year. A lot of months there were 20+% higher than they were in 2013. And 2015 built on that and grew those numbers by yet again another 8, 9, 10% in many months. So continued growth. So here's the big question, right? We've got more milk. We've got more product. Where is all of this product going? Well, not here. And basically, as we talk about the Chinese situation, you'll see from a total solid standpoint, their imports have been, well, lackluster at best, despicable would be probably the more appropriate term. Things have been down quite severely there. The good news for us is a lot of other countries have stepped in to try to pick up some of the slack. You've seen growth in a lot of non-traditional markets, and that's been very helpful as we're looking for homes for all of this extra product. And so you've seen countries like Indonesia and Malaysia and Egypt and that whole Southeast Asian corridor in northern Africa step up to the plate to try to soak up some of this extra supply and fill in their cracks for their needs as we go forward. And if you look at the story in New Zealand, you essentially see what's happening there. They provide most of the powder to the world, and if you look at their powder exports, China's not buying, some other countries are, but net to the bottom line, exports are still down 1.5%. So some continued stockpiling taking place there. Here's the other situation, right? Russia hasn't been buying product for a very long time, especially from the EU, and for the Europeans, as we saw in previous slides, cheese production is a very big deal. And so when you look at their contribution to Russian needs over the course of the last year, you can see that it's been almost nothing. And obviously Belarus has picked up the slack here a little bit as Russia tries to grow its own dairy industry internally. Neighboring countries that are still on the good neighbor list in Russia's eyes are able to provide them with a little extra product. Here we see it. Belarus has picked up some slack, but notice the big difference between their total demand leading up to their ban of European products and where they're at today. It's cut in almost half, and so that product has to go somewhere. Butter, same kind of story. You see that Europe has been cut out of the action. Belarus has picked up some of the slack, but certainly as we look at total demand, it's much lighter as we've seen in previous years. Powder, not so much. Again, Belarus has kind of picked up some of the slack there. Fluid milk sales, while it's had a really good run this summer, June, July, August have seen some upticks year over year. On the year, we're still lower, and the general trend over time is that is the case. Consumers in the United States just don't drink milk the way that they used to. The good news is we're moving into the time of the year where they tend to drink a little bit more. So hopefully that'll help pick up some slack, but that's not been a really good trend. Here's where it's going, and this is the unfortunate news for us. If you look at warehouse stocks around the country, what you're going to notice is not only are they higher than where they were last year, but they're at record levels. We have more cheese in storage than we ever had, and as we go into the month of October, and obviously that cold storage report that will come out next week, that'll help shed some light on this, but we expect some of the same trend going into next week's report. Big stocks. We talk about whey, there again, record supplies for this time of the year. Not the biggest ever, but we are month by month showing bigger numbers than we've ever seen. Butter, a little bit of a better story. You look at September, it's higher than where it was last year, but less than what it was in 2013. And so it's maintaining a little bit more balance there than what we're seeing in some of these other markets. Non-fat, for every single month this year, with exception to August, we set a new record for that month, and September was no exception to that. We wait for October's numbers, but based on what exports look like, it's likely that we're going to be seeing bigger numbers of non-fat stocks in October. How has this played out in price? And I think this is where everybody's mind is. We want to try to figure out what the future holds. Well, if we look at Tuesday's GDT event, this is essentially what we saw. Butter was the only product that ended up trading higher. It finished at $1.20 a pound. Everything else was lower. Cheese at $1.31, Skim at 84 cents, whole milk powder at 98 cents. Current U.S. prices have us at $2.88. So you can imagine, as a U.S. seller of butter, that you're not going to be pushing a lot out of our borders when there are people willing to offer it at $1.20. Cheese is kind of the same story. Specialty cheese gets a little bit of a grab, but the world cheddar market is trading $1.31 out of Oceania. And powder, this is where we actually get a little bit of action in the export market, provided that our currency doesn't get in the way. Our powder is coming in at a 78-cent price, which can compete with some of that skim market. As we talk about comparables around the world, you can see that while we're showing cheese at $1.31 in Oceania, Germany's comparable, the Edamer, is priced at $1.13. So not so good news again for us in the export market of cheese. The comparables on butter, you can see it here. Obviously, we are way out of the ballpark, and it'll take quite some time before we're able to compete there. Skim milk powder, again, this is a market that is showing us some some opportunity, but it's not over the top, and this is where the dollar value can start to muddy the water. So let's talk about what you guys are all concerned about, and that is what you get paid. If we compare the United States market in terms of our current pay price to what's being experienced around the world, what you're going to notice is that our neighbors to the east are getting about $14.37. Europe is, at this moment in time, relative to our spot market, about 50 cents cheaper than where we project December at in the coming months. If you look at where we're at in Oceania, that's where things get a little bit ugly. Nobody wants to talk about 10 $1.5 milk, but that's what they're going through right now, and part of why their production is expected to be down about 10%. So what about our markets? Well, if you look over time, the blue bars represent the average price in any given calendar year. The green line at the top represents the annual average linear trend, and the yellow and red represents the ranges of price in any one of those years. The red line representing the absolute range, and the yellow representing the trend of those ranges. And what becomes pretty clear as you go back over the course of the last 20 years is that not only have our annual average prices increased, but the range of prices in any given year have also widened. So bottom line, more volatility. And as we look at the pattern of late, what we notice is that we generally tend to swing from periods of less volatility to periods of more volatility, and certainly this year is one of those low volatility years where coming through it we have about $1.80 range from top to bottom, and not a whole lot to really show for changes in price. But as we go into next year, there is some hope that we can find some volatility, and what that means for dairymen is largely we're expecting a lot higher price opportunities after we get through some of the sluggishness and we get through some of the concerns that we have right now. So second half of the year potentially, third quarter maybe, nobody knows for sure, but maybe that is our time when better price opportunities begin to reveal themselves. Nonetheless, we're looking for, if the trend continues, more volatility in 2016. So where are we at right now as we talk about the 2016 milk price average? And the label at the top, I apologize, I got my calendar years wrong, should say 2016 Class 3 milk price average. As you look at it, you're seeing a price right now of about $15.88, and you'll notice that this is comparable to that low price that we saw in late August. Certainly not the best price we've seen. In fact, for the year, it's the worst price offering we've seen. But again, relative to what we're looking at in other parts of the world for pay price and relative to what we're looking at in terms of product value, this may still very much be a good opportunity as we move forward in the coming months. Seasonality looks like this, and as we go through any given year, you guys can all relate to this. We ordinarily see our peaks in September, October. Price falls off, we move lower into spring, and then we look for a recovery after we get through the spring flush, and component values start to slide in terms of volume. We start to see that summer move towards higher prices. We hit the peaks in fall, and we do it all over again. So when we go back and we take a look at this chart, we don't get totally taken off guard by the fact that markets have been moving lower and having an impact on price offerings in the coming year. Here's a comparison of 2015's actual futures, and that's the red line relative to what we've seen in previous years. You'll notice it's a pretty flat curve. There's not a lot of stout seasonality in it, but you'll still notice that there is some. And as we talk about the offerings in the futures market in the months of November and December, which are still being worked out, those markets could in fact continue moving lower. As we look at the Class 3 milk price pattern, what you're going to notice is that over the course of time, we've had lower prices that have worked their way, and again, with volatility, up into higher prices, and we all like to see that, but we're starting to now breach that $16 threshold that we've kind of rode on over the course of the last several years, and has kind of become the bottom end of this market. And I think that's why a lot of producers at this stage in the game have been hoping that the market would show us a little bit of turnaround in price, because over the course of the last several years, almost a decade in fact, with the exception of 2009, this has become a bit of the low end of the market. So if in fact we can breach the $16 threshold, we need to start to respect the fact that lower prices could be on the way. And as we break that down a little bit further, and you take a look at what historically that's meant to us, you can kind of see how this breaks down. We traded in a range back in the 80s and early 90s from $10 to $13. and from there on $13 to $16, and then over the course of the last several years, we've seen a lot of peaks up in that $21 range. Now we're breaching $16, and I hate to say it, but $13 is kind of the next stopping point. That's where the market finds its next support, where product values would suggest we trend towards, and that ultimately is where we frame up our discussion in terms of price expectation. In terms of probability, when you look at the course of time, about 59%, almost 2/3 of milk prices, and we're talking about class 3 base here, have landed in this range between 13 and 19. We've come down off 19. We're now sub 16. It's not shocking that we're in this range and looking for $13 potentially. We spend a lot of time here, and this is just the last 10 years. This isn't going back to those early 1980s, 1990s numbers. This is the last 10 years. We spend the majority of our time in this range from $13 to $19. Very little time is spent near 20, and that's, I think where everybody hopes that we would go, but we spend little time there. When we talk about the current path that we're on, again, we look at this 2015 marketplace, and what you're going to notice, that narrower red line that sits right above it is 2013. We're fairly analogous to that, with the exception of one thing, and that is the second half of the year we've been trending lower. Obviously, the end of 2013 birthed the 2014 opportunity, and you could see markets building momentum as we got towards the end of the year. 2015 is moving in the opposite direction. So should we expect this massive explosion to the downside as we get towards December and January? Well, I wouldn't be looking for a $7 sell-off like we saw in the hike of 2014 coming through January. But at the end of the day, going back to our discussion about seasonality, let us not forget that this is the time of the year when that normally happens. So again, we go back to the 2015 marketplace and we look at where we're at, and we're being given this 1588 number as a 2016 average. The reality is that these lower prices, despite being a match of that low August price that we saw previously, may be one of the better opportunities that we have over the course of the next several months. So that's the market in a nutshell. We're going to open this up for any questions. Before we do that, though, let me again, they reminded you that this is a Dairy Strong kickoff, so to speak. Let me put a plug in for the market update panel that is going to be hosted at this coming year's event. So far on the panel we have Robert Fox from Wells Fargo, Mary Ledman, and some others that will be announced at a later time. But bottom line, we are in a place where we're getting prepared and very excited for what they're going to bring to our event this year. So with that, we'll return to questions and open it up for whatever you guys have on your mind.
So as a reminder, if you do have questions, the easiest way to ask them would be through the instant messaging function. There's a small conversation bubble in the bottom left-hand side of your screen. If you don't see our conversation, you can click that and it should pop out. So feel free to type your questions in there for Mike. Otherwise, feel free to get a hold of him at his email or his phone. Otherwise, we can try unmuting the audience if anybody would like to ask their question and doesn't see the instant messaging box. So let me see if we have that ability. All right, well, I'd like to thank Mike for his time and for sharing your expertise with us. I'd also like to thank those of you who participated. We really appreciate it, and I hope that the experience went smoothly. But we would really welcome your feedback. So if you have any comments about the platform or the presentation, you can get a hold of us here at Dairy Business Association or send your comments to Mike and he'll get them to us. And we hope that you'll join us on our next Dairy Strong webinar, and we hope to see you at Dairy Strong in January. Just as a reminder, it's January 12th through the 14th in 2016 in Madison, Wisconsin, and registration is open at dairystrong.org.
Well, thanks, Lauren.
All right, thanks everybody.